Well, it's definitely been a tough last couple of weeks, hasn't it? The market really kind of stinks right now. And if you're logging into your statements online and checking your account balances, whether it's your 401k, your brokerage accounts, or really probably any investment you own at this point, you're going to see that the market overall has declined. And I know we talked a lot about this last week in terms of market volatility and in terms of Trump implementing a lot of tariffs and creating uncertainty. And that narrative has really only continued from last week in terms of Trump implementing tariffs on aluminum. He's implemented tariffs on Canada and Mexico, and he's also talking about implementing tariffs on European nations as well. So let's break this down a little bit and discuss some of the rationale behind the recent dip, as well as some of the silver linings that have come along with it, because there definitely are some silver linings despite what everyone else might be seeing out in the world or hearing on the news. So a lot of the recent data and analysis coming from the recent pullback, of course, yes, a good reason for the pullback is due to the tariffs, but it hasn't been fully clear that the tariffs are the number one driver behind the recent pullback. In my personal opinion and view, I think we were really overdue for a market pullback. Typically, market pullbacks occur of 10% in that range every 2 to 3 years or so. And we're just at that point where markets have really been up significantly over the last 2 to 3 years. If you logged into your 401k, your other investments, it was always a pleasant sight. The number just went up, right? All the charts were showing up. People were seeing great gains, great growth, and everything looked really, really good. And that table has turned, right? We're now seeing investments really start to drop and cool off and somewhat reset a lot of their valuations. And again, I think we were just really overdue. I think the tariffs gave the market the push that it was kind of looking for. And I'm surprised it hasn't happened sooner, because we've seen a lot of just ongoing issues, especially around inflation. Inflation has been so persistent for so long, and the Fed has just struggled to get interest rates down to where they wanted to. And I thought the market was going to pull back a lot sooner with all of this data coming out. And the market really prevailed. U.S. companies especially stayed extremely resilient and strong. Earnings across the board for almost all companies were meeting analyst expectations every quarter or exceeding analyst expectations every quarter. This last quarter alone, about 78% of companies from the S&P 500 index reported that they were beating analyst expectations in regards to earning. And it really has created this wonderful and very comfortable time of investing for a lot of folks. And with the tariffs coming out, I think really what's causing a lot of the pullback is just more of the uncertainty around it, not necessarily the final impact of the tariffs. A lot of these tariffs are still really new, and the economy has not digested what's actually happened, right? It's just like eating a meal where you eat something right away, and oftentimes, it takes 8 to 12 hours for you to fully digest it, right? Especially if you have like a big dinner, right? Or I'm Italian. I like to do the Sunday dinners every once in a while, and we eat at like noon, and I'm full. Usually until Monday, I'm pretty full, right? It's the same concept where the economy has just eaten this really big meal early in the day, and it's not quite sure how it feels yet. And that's exactly what we're seeing. So again, part of it, the tariffs are not helping the situation by any means, right? They sort of gave the market the push into the somewhat correction territory of just markets overall being down. But it's still hard for us to say, okay, what is the true cause of the market pullback? And it's probably a mix of a few different things. We do know that the economy is cooling. The CPI numbers came out today, and those numbers have really been pulling back, right? And that's just a sign that overall the economy as a whole in the United States and internationally is slowing down. And we've talked about this, right? Especially in the tail end of last year in the fourth quarter, I talked a lot about in December saying the markets are really great for 2023, 2024. We're likely not going to see the same level of returns in 2025 because the economy is cooling off. And that's exactly where we are right now. Again, for me, this was very expected. I think in terms of timing, that was probably somewhat unexpected just because the pullback happened relatively quickly with a lot of uncertainty in the news around tariffs. But let's transition a little bit and talk about some of the planning opportunities this creates for investors on a broad scale. So for folks who are approaching retirement or in their early retirement years or mid to late retirement years, of course, you always want to be very mindful of managing risk, right? So if your portfolio now is declining, just make sure that the risk level in your portfolio is aligned with your overall retirement planning objectives. Meaning that if you went into this taking more risk than you really were comfortable with, or more risk than your retirement plan allowed, then I think it definitely warrants reassessing with your financial planner and investment professionals of saying, hey, how can I reduce some of this risk, right? For folks that are maybe on the other end of the spectrum where they might have a little bit of time to sort of ride this out or have some extra money lying on the sidelines to say, okay, maybe I can put some money to work. Now is creating somewhat of a really good opportunity for a lot of folks to buy the dip. Warren Buffett has famously said in the past that buying opportunities exist when there's fear in the markets. And that's exactly where we are right now. And as an example, if you buy something high and then sell it for low, you're always going to lose money, right? If you buy something for $10 and sell it for $5, you lost $5 and you'll continue to lose $5 every time you complete a transaction of that nature. On the flip side, if you buy something for $5 and then sell it for $10, you've made $5 and you'll always continue to make $5 on a transaction of that nature. So with that in mind, if you have the risk appetite or the capability just due to your time horizon situation to wait this out, I think that makes more sense than really trying to transition your portfolio into a new strategy altogether. Of course, there's always opportunities to maybe reallocate and say, okay, Trump has said that he's going to implement tariffs on international stocks. Maybe international stocks are going to face additional headwinds compared to domestic stocks, right? Maybe we've seen a good pullback in technology stocks and maybe the financial sector has done well. So maybe we want to sell out of financials and move to technology. I'm not saying that's what you should do. I'm just sort of giving an example of just the overall concept of the markets. I think another thing to note too is that the best days in the market historically occur very frequently after the worst days, and missing the best days in the market has a huge impact on your overall investment returns. The S&P 500 over the last few years averages around 9.8%. If you miss the single best day, you miss one day in the market on its best day out of the course of the year, your returns on average, if you were invested in the S&P, drop from 9.8% to about 6%. If you miss the best 2 days, just 2 days in the market, your returns historically will drop from 9.8% to 3%. And at that point, you might as well just have stayed invested in a CD or in bonds or a money market fund. You would have done better in a different asset class. So again, this is just a reminder that there's always risk when it comes to investing, and it's very important to make sure that you have your actual plan at the front of your mind versus letting your emotions take over because you see the number dropping in your portfolio. Psychologically, it's always more impactful. Studies have shown that when you're looking at your portfolio going up, you feel good, right? The strength of your emotions is about 100%, right? The strength of your emotions when the market is down or you see your investment portfolio decline is at about 300%, which means it causes, on average for most people, 3 times more stress or level of emotions when you see the market going down versus the market going up. So it's human nature is what I'm saying, right? Human nature dictates to us that we need to avoid negative situations. If we're in a positive situation, that's great, but we would much rather avoid a negative situation than not be in a positive situation at all. We'd rather just be neutral at that point. So again, this is just a really good reminder that acting on emotions can have long-term negative effects of your investment strategies versus staying consistent in your portfolios and saying, okay, do I have the capability to somewhat wait this out? And if you do, then that's ultimately what you should end up doing. You're going to end up being better off 100% of the time than not, right? And for those folks that stay invested, especially if you have a long-term time horizon, I'm going to put a chart on the screen showing the likelihood of returns in the S&P 500 over different time frames. And if you see, right, if you're someone that's maybe in their 30s, 40s, maybe in their 50s, and you still have at least 15 years or so to stay invested because you're continuing to work and producing income for your household, if you wait those 15 years, 100% of the time, you're going to have growth, right? And that's just historical averages. So if you do have the capability to wait these out, short-term pullbacks and corrections occur. They're a part of normal market cycles. Again, I think they're somewhat healthy, right? And if you can wait it out over the long term, over the long haul, then your portfolio is going to be okay. One of the other silver linings that we didn't talk about as much, but I think is somewhat timely for tax season, is a strategy called tax loss harvesting. A lot of folks, especially in non-retirement accounts, are typically subject to dividend reinvestment. You'll get a 1099 for that, or unrealized capital gains if you make a portfolio reallocation, or if you have to sell something for an unrealized gain. That is a taxable event in the eyes of the IRS, even if you reinvest that money. It doesn't matter if you take the money as cash, if you buy something else, if you move it from one account to another. As soon as you sell something for a capital gain, the IRS will send you, or your financial firm will send you a 1099, and the IRS will require you to pay capital gains taxes when you file your return the following year. When markets pull back, this creates an opportunity for maybe you have very highly appreciated stocks or highly appreciated mutual funds or ETFs or other assets, and maybe you were looking to reallocate but just simply couldn't because the tax burden was too significant. This could create some opportunity for you to reassess and say, okay, maybe my unrealized capital gain was at $10,000 and now it's at $5,000, and I'm okay paying capital gains tax on $5,000, but not at 10. So now it creates a good time for me to go ahead and re-strategize a little bit. For folks that might have investments that are now below the unrealized gain threshold, meaning that they have a negative unrealized gain, you can actually reallocate your portfolio or sell some of these funds for a loss and then use those losses to deduct on your tax return the following year, or you can use those losses to offset gains in other funds. As an example, maybe I have a fund that has an unrealized gain of $10,000. I have another fund that has an unrealized loss of negative $10,000, right? And I could say, well, I've been holding on to this one fund with an unrealized gain and I was looking to reallocate it. I'm going to sell that fund, also sell the other fund for a loss, which creates a $0 gain. And now I'm not going to pay any taxes and I can reallocate my portfolio as I see fit. So these types of situations can create really, really nice tax planning opportunities for a lot of folks. Again, you have to be somewhat strategic on it in terms of making sure you adhere to wash rules and things of those nature. But as long as you come up with a cohesive plan that meets the IRS guidelines, then it's perfectly allowable. And again, it creates really, really nice tax planning opportunities for a lot of folks out there. So this really only applies to non-retirement accounts. For retirement accounts, capital gains are not a factor, right? Traditional IRAs, 401ks, Roth IRAs, employer-sponsored plans, those plans are not eligible for this type of tax planning, but any brokerage accounts, maybe joint accounts, transfer on death, or just individual accounts, all of these types of accounts can create opportunities for tax planning. So again, with that in mind, I know there's a lot going on in the markets right now. Things are definitely a little bit scary, and I know it's making people nervous. And we've been getting some calls over these last couple of weeks from clients reaching out and saying, hey, what should we be doing? Is there any opportunities for us? And really the biggest opportunity is staying put. If you have the capability, maybe buying some of the dip, I think is a good opportunity as well. And if you're concerned about buying the dip and saying, well, I think the market still might continue to go down, you can implement a dollar cost average strategy and say, okay, I'll do, $500 a week for the next 6 weeks and see how that does. And I can buy the market at different price points, right? And then of course, the third strategy to consider looking at would be tax loss harvesting or any other sort of tax planning around capturing losses within your portfolio. So I know it's been a tough couple of weeks. I encourage everyone to do their best to hang in there. And again, we're here as a resource for each and every one of you at Vision Retirement. So if this is top of mind and you just want to talk it through on a more personal level and see how it applies to your situation specifically, then of course you're always welcome to give us a call. You can shoot us an email. You can schedule a Zoom meeting with us, come to our office, whichever you prefer. We're happy to spend some time and just go through what's going on in the markets and talk a little bit deeper than this video today about some of the analytics that we're seeing and share with you our professional views. So with that in mind, thank you so much for tuning in today. Hopefully the market bounces back in the next few weeks, but we'll continue to talk about what's going on. I know when the markets are down, the news and the headlines tends to be much more in your face than when the market's doing well. So as long as this is relevant, we'll continue to talk about it every week. And of course, if any questions come up, please reach out to us and we're here to have that conversation with you. So again, thank you so much for tuning in today, and I'll talk to everyone next week.